There's lots of people who study for years for their qualifications to understand stock markets, economists, strategists, people who want to be advisors. And the following sentence, which is in your copy, kind of negates a lot of their education. High valuations are not an effective timing signal, i.e., what I believe you're saying there, and I'll say it in my own way, is forget about all your valuation criteria, just buy the market because because momentum is a better calculation of how to make money at the moment rather than all that knowledge you have acquired about valuations.
So what we find is that valuations are a great market timing signal when they're very cheap. So when valuations are cheap, the odds of positive returns over the next
Unless it's European auto sector.
I should say in the US.
Yes, okay.
In the US, when valuations are cheap, we have seen historically the odds of positive returns over the next 1 in 5 years are very high. When they are expensive, though, that on its own is not a good reason not to be invested.
So valuation criteria that CNBC, international, and especially in the US, we've got hours of, ladies and gentlemen, I watch it every morning when I come in, it's on the video, like talking about this value, this value, this value. It only works when they're cheap. When actually something's trading at 40 times forward or 50 times forward or 20 times sales, you've got to hold your nose and ignore it?
Not ignore it, but what we're saying is that in the case of the US specifically, valuations can actually remain expensive for an extended period of time. So valuations today are in what we call the 10th decile of their historical distribution, meaning they have been cheaper about 90% of the time historically, so very expensive. But what we find is that the US equity market can remain in the 10th decile for years and years and years and still deliver attractive returns for investors. So what would lead us to worry more about the outlook for equities would be if we thought a recession was likely in the US. But we assign only 20% odds to a US recession this year.
Well, if US equities look boring, there's always Bitcoin. And you're pointing out that it's still more than 4 times as volatile as US equities. Some people like that volatility because they get an enormous swing high when it happens and they try and play that trade. Of course, it comes with the caveat that you could lose that same amount in a very steep fall. But how does Bitcoin look to you when we've got an incoming administration that seems very favorable to crypto?
Absolutely. So we actually don't recommend a strategic asset allocation to cryptocurrencies in our clients' portfolios. The reason for that is because we don't see them playing any of the significant roles asset class need to play in order to be included in the portfolio. They do not provide diversification benefits, they do not dampen portfolio volatility, they do not generate steady cash flows, they do not generate earnings, and they are not a great hedge against either inflation or deflation. So as a result, we don't have a strategic asset allocation to the asset class. The problem that we have there is that we just don't know how to value cryptocurrencies, right? You can arrive at a price for them, but that is very different from knowing what their value truly is. So as a result of that, we don't recommend an allocation to crypto.